Hi, I'm Eddie Sanderji, and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. Jeff, welcome back.
Great to be here, Mehdi, as always.
So we're coming off a long weekend, and while I was eating chocolate, Jeff was working and publishing his weekly piece on Sunday night. And you can find Jeff's newsletter on Substack at hugeinsights.substack.com. And while I have your attention, don't forget to like and subscribe to our channel as well to stay on top of our content. So, Jeff, without further ado, I do hope you'd had a wonderful long weekend and got some R&R in somewhere along the way. So,
We did.
good, good. I'm very glad to hear that. So, shall we kick off as usual with the top down?
Yeah, a lot of people are wondering what's going to go on with the inflation report this week. Last Friday, we got the NFP report. That came in more or less in line with expectations. As you know, the markets were closed on Friday, but the futures were open for about 45 minutes or so after the reports. We saw the initial reaction was kind of okay, it's a nothing burger. Yesterday, we saw an initial negative reaction as people were kind of second guessing that. Ultimately, we ended up finishing the day kind of, mixed, if you will, a little to the upside. This morning, it looks like the markets are opening flat ahead again tomorrow of the CPI report, which I think is going to be, kind of a big deal. Expectations are now that, maybe the Fed's going to have to raise another 25 basis points in May. The odds are now split 65-35 last I looked. And, it stands to reason. Inflation continues to, look like it's well above the Fed's target of 2%, probably, mid 5.5% or so on the CPI and 4.5% on the core PCE. And so, that's nowhere near 2%. There's a lot of people saying that the Fed's going to, stop hiking and immediately begin reversing course within a couple of meetings. I think that's highly unlikely unless the recession that our work suggests is imminent were to occur sooner and with a greater degree of magnitude than the street's currently forecasting at this point. And so, I think at this point we have to kind of, let the data decide what's going to happen here, but be prepared for the worst. We continue to suspect that earnings revisions to the downside will spiral much lower. And as a result, we think valuations are just way too high. We've been advocating for our clients to minimize net equity exposure in this environment and maximize cash reserves where you can currently earn upwards of 5% completely risk-free in a 3-month T-bill. So that's our view.
Well, thank you for that. Before we get into some of the technicals and some of the deeper topics, you also touched this week on the focus on China and U.S. relations, as as most of the news shows have been. But you have some thoughts around this topic. Why don't you run us through these?
Sure. As you know, we've been writing about this for many, many months, the better part of the last year, in fact. And last week, Taiwan President Tsai Ing-wen met with House Speaker Kevin McCarthy during her visit to the U.S. And that raised the ire of China. And, shortly thereafter, China launched a 3-day live fire military exercise in the South China Sea, which basically included about a dozen ships, 90 aircraft. And from what I read, tens of thousands of troops were put on high alert. So, you almost have to ask yourself, was this really an exercise or was this basically a reality disguised as an exercise? We'll find out in the fullness of time. But at the end of the day, China's military, their Navy put on a full-on naval blockade of Taiwan. It was pretty dramatic, although I should say commercial aircraft were continued business as usual. There were plenty of commercial aircraft that were allowed to land in Taiwan and take off. And so obviously it wasn't a military invasion. It was a military exercise. In response, the U.S. 7th Fleet is right now conducting a freedom of navigation operation in the South China Sea. And that's to show China that they're not the only ones with the Navy. They actually do have the second largest Navy in the world, though, and substantially more ships than the U.S. But the technology that they're operating with is something probably akin to Vietnam era technology. So, I don't think there's too much to worry about there.
So it's like potato, potato, preparing for war, or is it an exercise? Who really knows at this point? You also looked at bank lending, or should I say more accurately, I guess, the collapse of bank lending. What are the wider implications of this on the broader market?
Sure. For those who have been worried about an impending credit crunch, they need look no further than the last 2 weeks of March to see said credit crunch in action. We saw basically new loan originations in the month of March decline on average across all classifications about 20%. That was horrific decline, and in fact, what we're seeing in the first couple of weeks of April suggests so far that April's shaping up to be just as bad, if not worse. So, we take a look at what happened. Three of the weakest regional banks failed in, just epic form in early March, right? First, we had Silvergate Bank, which lends to crypto. We had Silicon Valley Bank, which lends to venture. And then we had Signature Bank of New York, which is also kind of involved in some sketchy lending as well. And so all three of these banks went down, as all will know. They were taken over by the FDIC. The FDIC took kind of emergency measures. They expanded the insurance coverage to include non-insured deposits as well. Nevertheless, the bank run was nothing short of epic. We saw $105 billion withdrawn from demand deposit accounts in the banking system, not just those banks, but across the banking system. Now, in all fairness, some of the big SIBs, these systemically important banks, or SIFIs, systemically important financial institutions, those include the names like JP Morgan, Bank of America, Citigroup, Morgan Stanley, Wells Fargo, and Goldman Sachs, to be precise, in the U.S. And there's many others outside of the U.S. But at the end of the day, those big banks were the beneficiary of receiving some of those deposits, but not to their ultimate benefit. Anytime there's a break in confidence in the U.S. banking system, it affects all banks. And that's a quote from Jamie Dimon's recent letter to shareholders. And so, my suspicion is at this point that no one benefited from this. And in fact, the $105 billion that was puked out of the banking system found its way into money markets and treasury securities as an alternative to seek safety and yield. And this is not going to be good for funding of loans. And so, as we're looking at this collapse in new loan origination, our suspicion is that it is the beginning of something, not the end of something. This is likely to persist and proliferate throughout the U.S. economy. And for that reason, we believe that the clock has been ticking for some time now, but the second quarter is really our target zone for recession to emerge within the U.S. economy. And we think it'll be crystal clear by June of this year, if not sooner.
Well, thank you for that breakdown. And touching on something you mentioned in your opening statement, looking at street earnings estimates, you certainly are lower than consensus. Can you talk us through your thoughts around here?
Well, I think I'm in the street low right now, but let's. I can't prove that, but from what I can see, I'm the low on the street for 2024. But I'm not publishing to FactSet or any of these sources, so it won't show up. But my clients know it, and what we did is we introduced our 2024 S&P operating earnings estimate at $187. Now, that's only down 5% year over year from our 2023 estimate, which, as all will know who've been following us, that number had been 198. We just lowered it to 197, just $1. So we're looking for a 10% decline in 2023 year over year. It looks like 2022 shaping up to end the year at 219 and a quarter. If everybody's reported, I think that's a good number. And so that's the actual. We're looking for a down 10% from that. That'll get us to 197 this year, and then down another 5% in 2024 to 187. That puts us 30% below the street consensus for 2024. The street is at 217 this year and 244 next year. That's based on S&P Global's numbers. I know FactSet and IBIS are slightly higher. I think I saw IBIS number was at 248 and change. But I think S&P Global is a better source for consensus. Things tend to merge in that direction. And I think it's giving the street the benefit of the doubt at 244. I guess our point is simply this. We believe that the economy is on the precipice of going into a recession, if not already in recession. And as a result, we just simply looked at the data. This data was published by a number of sources. We've highlighted D.A. Davidson in the past. They looked at S&P 500 operating earnings during recessions going back to 1957. There were 10 recessions during that period. They averaged about a year in duration, and estimates averaged down 29.5% year over year during a recession year. Now, if you eliminate 2001 and 2008, the two worst earnings collapses within that framework, it actually looks like the average would be around minus 18.7%. So we're looking at down 15%, which is pretty generous. I think, a lot of people say, well, it's really risky going out with a number like that. You're going to have egg on your face, et cetera, et cetera. I don't think so. I think if we're wrong, it's because we're still too high. And we may yet have to revise our 2024 estimate lower. Ouch. And look at it this way. Last thing I'll say. If we're right and our 2024 estimate is correct, then the S&P is trading at 22 times out year estimates right now, not the 16.8 that everybody believes it's trading at. And so, we need to see something like 6 multiple turns to the downside, a compression, basically in order to be at, say 17 times. So, I'm thinking at this point that, the market has not found its lows yet, and that the October lows will be taken out, and in the not too distant future.
There's a pretty wide spread on multiples, 16 to 22. Definitely going to have to keep an eye on these. So, Jeff, let's slide into some of our technicals. Looking at the market, it doesn't feel like we've had a breakout either way. Things feel a little status quo-ish right now.
Yeah, they certainly do. And again, to our earlier point about the inflation data, I think that's going to make or break the consensus view on whether or not we're going to get another hike in May. Our suspicion is that the number is going to be hot. It's going to be a little on the hot side. Services inflation continues to be, pretty significant, and wage pressures continue to be significant. And so, the two together, in our view, not to mention the fact that energy prices have started to move back up. And, we can look at things X energy and X food prices, but, energy prices flow through to everything else. And so eventually it starts to show its ugly head in the rest of the data. And so, even though goods prices have come down substantially, even used car prices have ticked back up. And so it doesn't look to me like the trend is necessarily decidedly down. We may be in a period of time where, we've kind of gotten through all the very difficult comps. And I know June's going to be a nice one to have roll off, et cetera. But, for now, it seems to me that the Fed still has work to do. A lot of the Fed governors have, been vocal about the need to get above 5%. That's 5.25. That's where I think we're going in May. And should we get there, I think that, people will continue to rethink this idea that the Fed is going to pause or reverse course just because we had a little excitement in the banking industry a month ago. I think that was the initial shot across the bow, right? And I think the torpedoes are in the water with the credit crunch and the implications for a very, very tight credit environment, and not to mention the fact that borrowing rates continue to be high. I just, one of my kids showed me that they just got a new credit card And I asked them, hey, what's the rate? Well, the max rate was over 30% APR. It's like, this is how banks are going to deal with these higher reserve rates that they've had to fund. They're going to charge significantly higher interest, and that's how they're going to fund it. So, this is going to be interesting when it happens. But the point with the technicals is simply this: we got to a juncture where the market is really it's at a decision point. Let's put it that way. And I think at the upper boundary of this kind of range that we've been in since May of 2022, the market can do one of two things. It can break out, and I'm sure it would break out to thunderous applause, right? And move a little bit higher. And that would suggest that our preferred count is wrong and that we'd have to move to the alternate count. But I don't think that's going to happen. I think that's a lower probability. I think what's likely to happen is that the market's going to react to negative data points in a negative manner, and that we're going to see a reversal here, hard down. We are at the setup in our preferred count is a third wave decline at 3 degrees of trend, minor degree, intermediate degree, and primary degree. We don't see that third wave decline ending until the market gets down into the mid 2000s, perhaps as high as 2750, as low as 2400, but somewhere in that range should mark the terminal point of primary wave 3 down. And if we look at this from a shorter term perspective, we can also see that there's now a 40-day cycle count that looks pretty active right now. And we're reaching the peak of that cycle count just about now. And so it's our suspicion that, sometime within the next few hours or days, the market is going to find its top and roll over if it hasn't already. And we should see the next 20 of that 40-day cycle hard down. And that should be something of an epic plunge, quite honestly.
Jeff, you every single week in, week out, whenever we have these conversations, you get the hairs on the back of my neck sort of flickering around on when I hear 2750 and 2400. Is looking at the internals, is it fair to say market internals have been trending weaker as well?
Yeah, there's no doubt. I mean, we looked at last week's advancing issues. Only 8% of S&P 500 issues advanced last week. If we look at the 5-week moving average, it remains negative. So breadth has been negative. Momentum has rallied off of a near oversold condition back above the median line, but it's fallen short of becoming overbought. And it looks to me like momentum is peaking here as well. When we look at net advancing volume, we did see about 57% of the S&P 500 stocks from a volume perspective, volume on the S&P advanced. However, if we look at the up-down volume ratio over the last 5 weeks, it's 1.37. That's exceptionally low. I mean, some might say, hey, it's over 1. That's positive, right? But really, for a durable bull market, you need to see 3, 4, 5 times for that 5-week moving average. And so, the bulls might say, hey, it's bottoming and we're about to turn up again. I don't think that's the case. From my lens, this looks like we're seeing a weakening of breadth, momentum, and net advancing volume. And under those circumstances, that does not bode well for a durable rally, especially when we're at this decision point position, the upper boundary of a declining trend line.
So look at sentiment. It seems that sentiment's sitting in that no man's land of neutrality as well.
Yeah, I would say it's come back from the depths of despair to reside now squarely in neutral zone. If we look at the name exposure index, this is the National Association of Active Investment Managers. They survey all of their members every week and come back with that survey data. And what they're suggesting is that active investors are now 73% invested. 75% is dead neutral. The neutral zone is 50 to 100. North of 100% is aggressive, leveraged exposure. But I would say at 73%, we're pretty well invested. Anybody who's running a balanced account for sure is fully invested. And so with that said, we want to look at the individual investors as well. And the AAII, the American Association of Individual Investors, reported the highest number of bulls in many, many weeks. 33.3% of their membership base that responded to the survey have described themselves as being bullish. And bears have come off the lows by far and away, now only 35%. So we're at a near equal bull-bear spread. It's actually just slightly negative, minus 1.7%. At zero, we're dead neutral, but in a range of kind of -5 to +5, that's really the neutral zone. I would suggest at this point that there is no fear in the market, none whatsoever.
No fear in the market. Well, is that what the sector kind of moves are telling you, though? There seems to be a bit of a theme emerging here.
Yeah, I think the sector support that notion. If we take a look at last week's action, and bear in mind, last week was a holiday shortened week, right? We had Good Friday off. So, maybe people were taking the whole week off. Volume last week was exceptionally low. Friday's volume was the lowest volume day of the year. And not Friday, Thursday's volume, sorry. And, if we take a look at the sector performance, we can see that healthcare and utilities and energy were the dominant performers. Now, energy benefited from, the idea that Exxon was going to maybe take over Pioneer. And so we got some speculative juices flowing in some of the smaller cap names, thinking that, well, there's a big M&A cycle in energy potentially here. Also, we had a big production cut announced, surprisingly, from OPEC in the not too distant past. And so, that continued to kind of pump up demand for energy shares, which is generally cyclical, but I think energy is very overowned. And I think the supply demand dynamics favor energy as a defensive sector right now. But take a look at what the worst sectors were. They were in descending order: tech, discretionary, and industrials. And I think industrials are now responding to the credit conditions that we discussed earlier. I think industrials are going to see some significant problems if they can't get funding for, inventory, for new factory development, things of this nature. I mean, C&I loans were down, I think, 30%. So they were worse than the average in that data set that we showed. At the end of the day, I think that, discretionary, which I think has the highest year-over-year earnings forecast by the street, is just insane. Okay, it's being driven by Tesla for one, and Amazon. But I think those numbers are going to be revised dramatically lower. And I think that's one of the reasons that discretionary is acting poorly. And we would expect these more cyclical sectors to remain under pressure, especially if the market does what we think it's going to do based on our market analysis discussion.
So, Jeff, what do we do? How do we make some money? Let's have a look at some of these top trader actionable ideas, or actionable trade ideas even. My English is going down the toilet. What do we think?
There's always something to buy. And, for professional managers that have to be fully invested, they're going to be looking for places to hide in this scenario. And I think that utilities represent a pretty good hiding place. They have yield, they have regulated earnings, they have, not a lot of elasticity of demand. They're less economically sensitive, certainly at the household level. But we like one called Edison International, symbol EIX. Stock went out around $72 yesterday, or I should say last week. I guess yesterday. And, the breakout above 72, we think has the ability to propel the stock up to around 89. We use a measured move sort of a calculation to get there. That would suggest about 23% upside. We would set a stop loss at $68 to protect capital. This sets up a nice trade, a 3-to-1 positive risk skew.
And do you have anything on the short side?
On the short side, we think Albemarle, symbol ALB, looks like it's vulnerable here. The stock went out around 194 yesterday. It broke down below $200, which sets up a further, target to the downside of around $130 initially, but potentially as low as $65. That would suggest something at the bare minimum about a 66% upside potential for a short seller here. But we think if you're a long only manager, this is a name to avoid. We would set our stop loss at 220 if you're a short seller. That gives you a pretty good greater than 3 to 1 positive risk skew to our stretch target.
Fantastic, Jeff. Thank you so much, as always, for sharing your thoughts from Alpha Insights.
Always my pleasure.
And I want to thank our viewers and urge you to check out Jeff's content on Substack at hugeinsights.substack.com. And don't forget to like and subscribe to Your Finance TV. Until next time, good luck investing.